This meeting is being recorded.
Okay, good morning, everyone. Today is Sunday, the 6th of November, 2022, and where we'll be having some of our discussions as it relates to revision class for Ican November 2022 examination with respect to financial reporting. Today we'll be looking at statement of cash flows in line with the requirement of IS 7. Okay, and we'll be making use of May 2022 diet examination question 4, to more or less address this revision. Okay, thank you very much, and your effective participation will be required with respect to questions, contributions, as the case may be. Now, in this slide, I'm going to take you up to where we might likely want to start from, so that we can more or less provide some preface to what we understand or what we know before now. Okay, we'll look at, we'll make reference to ICAN material to more or less provide some introductory understanding about what we want to discuss. I believe at this point, every one of us have gone through this topic, or because you can't be talking about revision without necessarily going through the topic. Now, statement of cash flow is one of those statements in the financial reporting which goes against the principle of accrual basis. Okay, virtually, more or less all of aspect of accounting, or what we call financial reporting, border much more on accrual basis of accounting. Okay, with the exception of statement of cash flows. And you understand what that means, which means rather than just looking at performance and position with respect to accrual principle, we are looking at a statement that more or less rely on cash basis. And what is cash basis? Which means you, okay, somebody says she can't hear me. I believe if you can hear me, you can send a chat or signify from continue, because I believe people should be able to hear me. Can you hear me? Just say yes if you can. Okay, thank you. Yes, quite well. Okay, that the person need to log out. Means you more or less reflect cost and any form of cash, which means rather than rely on
Being recorded.
okay, between you being profitable and less liquid, or between you being liquid and less profitable, which one do you pick? Now, the rationale behind it is that cash flow can be seen as a blood to human. What it simply means is that if a woman loses blood at the spot and spot cannot be stopped nor replenished, that can bring about untimely demise or death. But when human being is hungry, it can still survive as long as possible, even though it's not something that it can survive for long. Which then means that when there's a trade-off between cash flow and profitability, cash flow takes prominence, or because it's something that you cannot hide, or you cannot deceive yourself. It's either you have money in your pocket or you don't have. But in other things, you can deceive yourself. Okay, and that is the position there. Okay, now when we also look at statement of cash flows, we are going to be looking at it from three perspectives or three activities. One is a core activity, while the other two are supporting activities. The core activity is usually considered as the operating activity, which is the activity that experiences the main or principal source of business to an organization, where it's expected to principally generate on a continuous basis and sustainable basis is cash flows. Okay, and that's where it's also expected to utilize most of your cash flows. Whereas we have other two activities, investing activity that supports the structure that allows the operation to go on. Okay, that's where you invest much more with respect to tangible assets. Okay, and also we have the financing activity, which is a source of finance to a business and source of giving return to those that have contributed to the business in one way or the other, either as a debt holder or as an equity holder. All of these are things we are going to take into consideration, okay, today. Also, with respect to the core activities, there are two methodologies that are possible. The first one is the direct methodology, where you see sources of cash flow from activities that the organization more or less involve itself in. For example, sources of cash flows when you make use of indirect will be much more with respect to cash received from customers mainly, and any other cash received from any other activities you have involved yourself in. While cash paid are usually attributed to payment to vendors, payment of salaries, payment for expenses, and payment of taxes and the like. Okay, and that is that. Okay, but again, there are other there's another methodology. In this case, we call it the indirect method, and this methodology tends to reconcile our profits to our cash flows, which then means that indirectly we are trying to establish the relationship that may exist at every period between the profit you have and your cash flow from operation, as the case may be. Okay, but regardless of the fact, of this methodology is acceptable by a company. Okay, but the position of the standard is such that any time you use of the direct method, you are equally required to show reconciliation between your profit and your cash flow from operation. But whenever you make use of the indirect method, you may not, and you are not mandated to show your sources of cash from operation and your uses of cash from operation, other than reconciling the position you've shown under the indirect method between your profits and your cash flow from operation. And the thin line between that reconciliation are items that borders on adjustment for non-cash items, adjustment for non-operating items, and also at the movement in working capital, such that as they impact or create or utilize cash flows, such as movement within inventory, movement between trade payables, movement between trade receivables and the like. All of these I will take into consideration. Invariably, we'll be able to more or less arrive at our position, as the case may be, with respect to cash flow from operations. Also take notice that they are likely to provide either be treated under two Okay, I believe you can hear me now. Sorry for the technological glitch. Okay, now as we continue in our discussion, I said there are two or more items within the cash flow statements that can be classified under operating or under investing or under operating and under financing. Now, I'll give a practical example. For example, where you have interest paid, okay, interest paid principally or primarily supposed to fall under financing activity because that is where you have the source and repayment of finance. But sometimes it can equally be treated under operating activities, or because the interest paid is instrumental to carrying out operation. But again, it depends on the nature of your industry. For example, in a financial industry, interest paid will usually be operating activity, okay, without an option of classifying it as a financing activity. But for a manufacturing company, it also depends on the interest. Is it incidental to acquisition of property, plant, and equipment, or investment, or is it something that relates to working capital finance? Naturally, if it relates to working capital finance, I would treat it as operating activities. But if it relates to much more investment or intangible asset, I'll treat it as a financial activity. But you need to take note of it that either of the option, your consistency application is what matters in this case. Okay. Similarly, you have items like dividend received. Okay. And depending on your nature of industry, if you're an asset management company, dividend received constitute part of your core activities, and therefore it's reported within operating activity. But if you're in any other company like a manufacturing, and you invest your surplus cash, okay, you are going to treat such dividend received as an investment income, okay, investment activity cash flows, and that's just the position there. That's just to portray one or two things that we might come across as differences. But again, let's look at what we need to do today. But before we do that, I'll also probably indulge in one or two persons who may want to ask questions specific to what we've discussed or what I've not discussed before we go into solving an examination problem for the revision class. Okay, you can send the chat or you can show your hand. Okay. Any question? Show up your hand or send a chat. Okay. Toby, over to you.
Good morning.
Money.
Please, I want to ask, this page on preference share, will it be deducted
What
on
do you say?
the dividend paid on preference?
Okay.
Can you hear me? Can you hear me?
Yeah, dividend paid on preference share. What happened to it?
Will it be deducted on preference share, on the preference share in the non-current asset, or it will be taken to finance costs under POL?
No, wait. Okay, are you asking something not related to cash flow now?
Yes.
Okay, first, dividend you paid on preference share, there's nothing that will make you to deduct it from preference share capital. That's a no-no, regardless of what your position is. Okay, you can mute yourself. Okay, but when it comes to presentation in financial statements, okay, the presentation could either be within finance cost or within your statement changes in equity where you deduct it against retained earnings. Okay, and it's a function of the discussion we had under IS 32. Is the preference share classified as a financial liability, or is the preference share classified as equity instrument? Okay, if it is classified as a financial liability, in that situation, preference dividend will be treated as a finance cost, which means it will be deducted before arriving at profit before tax in your financial statements. Whereas if preference shares is classified as equity instrument, the preference dividend will be deducted against the profit for the year within the statement of changes in equity, or because it will be treated in similar like as we treat ordinary share capital. And likewise, the preference dividend will be treated similarly the way we treat ordinary dividend. And that is it. I believe that answers your question. Okay. Any other question? Any other question? Any other question for us to move on? Okay, it seems there's no other question. Okay, if there's no other question, I think we can proceed to solving this question we have at hand. Okay, let me enlarge this. Okay, can somebody volunteer to read this question for us? Can you signify by a show of hands so that I can give you access? And take note, the question is drawn from the Institute of Chartered Accountants of Nigeria Skill Level Examination, May 2022 for financial reporting. Okay, and the question is question 4. Okay, Kemidari, thank you. You can proceed.
Good morning, sir.
Good morning.
The following financial statements were extracted from the 2021 annual report, an account recently published by Odibeze Nigeria PLC. Statement of profit or loss and other comprehensive income for the year ended April 30th, 2021 is stated, and the statement of financial position as at April 30th, 2021 is also, you can see the table. The additional information 1. During the financial year, the company made a bonus issue of 1 share for every 6 shares held and a cash issue at 1 naira 90 kobo per share to provide funds for its anticipated expansion. Roman figure 2. It is the company's policy to revalue its freehold properties annually with any resulting surplus transferred to revaluation reserves account. There was no disposal of freehold properties during the year. Roman figure 3. A plant with a carrying amount of 20 million was disposed on September 30, 2020 for 11,200,000, while the depreciation charge for the year on the remaining plant and machinery of 24 million naira was included in the operating expenses. Roman figure 4. The investment income represents interest received on the trade investment during the year. The trade investment suffered impairment loss of 10 million naira by the year end. Roman figure 5. The company paid an interim dividend of 25 million naira and proposed a final dividend of 45 million naira. Required. Prepare the statement of cash flows of Odibeze Nigeria PLC for the year ended April 30, 2021 in accordance with IS 7 using indirect method. B. In the context of IS 7, statement of cash flow, explain the term cash and cash equivalents. List 3 examples. That's all, sir.
Thank you very much. Thank you very much. Thank you very much. Okay, what should we do at this point in time? Now, I want us at every point in time, we are more or less trying to solve a problem to get ourselves familiar with information contained in the statement of profit or loss and comprehensive income, other comprehensive income, also statement of financial position as the case may be. But what should I do at this point? Let me switch to, I'll be making use of Excel. Okay. Let me share. Now, somewhere here, let me put my okay, and so for my balance sheet and the income statements, I'll also try and put it somewhere again so that I can have, instead of me switching, I'll no longer switch. Okay, the last aspect, let me copy it. Okay, now let's look up very well to this information that we have. We have information on revenue. We have information on cost of sales. We have information on gross profit. We have information on investment income. We have information on operating expenses, finance costs, profit before tax, income tax, profit for the year, and we have items. The only item we have in other comprehensive income is relating to revaluation of property, which gave us a surplus, and our total comprehensive income. In our balance sheets, we have information split into two for property, plant, and equipment, and that borders on freehold property and also on plant and machinery. We have information of trade investment, which is like financial asset investment. We have goodwill, okay? And one thing we need to quickly take note of here is that we had goodwill at the beginning of the year, and as at the end of the year, the goodwill has vanished. Therefore, what could make goodwill vanish during a reporting period? We need to take note of that. Okay, current assets. Under current assets, we have inventories, we have trade receivable, we have cash and bank. Okay, now equity and liability, ordinary share increased. We need to take note of that. That increased during the year. What could bring about increase in ordinary share capital? We need to take note of that. Likewise, share premium equally increased from nothing to something. What could bring about that? We also take note of that. Likewise, evaluation reserve increased from 5 to 15. What could bring about that? I think we have an idea, but let's go back to where we had an idea. Okay, we had an idea here where they told us that there's evaluation on property. But surprisingly, what we have here is, but when we check the difference between these 2,000, therefore, what could bring about that? And you have something here whereby before now you have no preference shares, but now preference share is surfacing at 32 million. What could bring about that? Now you have trade payable, and you have your tax, and you have your bank overdraft. All of this information are critical to our discussion. Okay, and we are required to present for the entity. What's the name of the entity again? Let me check the question. Udibeze. Udibeze. Nigeria PLC. Okay. We have to prepare the statement of cash flow, statement of cash flow for the year ended. 30th April 2021. Okay, let's take note of that. All figure in thousands. Okay. Now we have any activities, we must take note we have, and first we are presenting this based on indirect method. An indirect method means we reconcile from profits. Okay. Now, the first activity we have is operating activity. I can leave like 20 lines. Nobody will penalize you if you leave SS lines. But again, depending on the methodology you are comfortable with, I can leave like 20 lines. Is this up to 20? That's 5. Yeah, this is about 20 lines. I come to investing activities. But if I'm using Excel, I can always insert and delete. For that, I might leave like 6 lines. 6 lines. My financing activities. Okay. That is that. Now I'll pick my item one by one. The first item I'm going to pick is what is my profit before taxes. What is my profit before taxes? I can check it here. My profit before tax is this amount. That's 85,340. 85,340. Now, the first thing you need to do is to carry out adjustments for non-cash item. And adjustment for non-operating items. And what are these items? We'll pick it one by one. Now let's start with information about depreciation. So far, an entity has depreciation. So far, it has a property, plant, and equipment, which has not been abandoned. Therefore, automatically there will be depreciation of such an asset once it's available for its intended use, even when it's not being used. Now, let's look at the information here. There's no information here that shows us the amount of depreciation, but we know that it may have been included either in cost of sales if it's the manufacturing related depreciation, or at least for administrative assets, operating expenses. But where we can get a better view is from our balance sheet here. We have freehold property and we have plant and machinery. Therefore, what do we need to do with respect to that? Therefore, I can come there and say working notes. And the first working note is depreciation. Depreciation on freehold properties. Now let's start with the information we have. As at the beginning of the year, what do we have? We have balance brought forward. And what's our balance brought forward? If you come back here, it is 385,000. Remember, this 2020, this 2021. Okay. Now, during the year, we have gain on revaluation of property, which is 15,000. You come here. What is the effect of that? Which means you have revalued it upward. You add gain on revaluation during the year, which was 15,000. Now, all things being equal, there was no additional information about purchases or disposal. Therefore, I sum this up and it gives me 400. Now, I'm supposed to have 400 in my books as at the end of the year if the asset has not been depreciated. But what do I have? I have 350 in my book. Now, what does that suggest? It would suggest that since I have not disposed of the assets, since I have not reclassified during the year, therefore, the only thing that will have brought about reduction, which is expected, is depreciation. Therefore, I'll compare my balance at the end, which I have in my balance sheet, with my purported balance that I ought to have, which is 400. I compare the two. This is expected balance, carry forward without depreciation. Not suffer. This was rather I have 350. Between 400 give me 50,000. Therefore, this is actual depreciation on properties. Put it red. Therefore, this is what I have as at the end of the year as our depreciation charge on property. Therefore, what do I do? Depreciation charge on property. What do I mean? Because that amount has been deducted from this income through operating expenses to arriving at that profit. Therefore, what you would do, we should add it back as if it shouldn't have been deducted. Therefore, what will I do in this point? I will add back my depreciation. And that's how much? Also, I still have one property. I still have another one. Probably I'll call it working 2. And that is on plants and equipment. Or plant and machinery. Okay, what is my balance in that? My balance in that is 242. 242. There's no evaluation. Okay, but we have information with respect to disposal. Here we are told that a plant with a carrying amount of 20 million was disposed of on September 30th for 11,200,000, which means there's an information somewhere here that I also need to have annexed, which is, I'll call it note 3, information regarding disposal of plants and the plant carrying amount was 20. Okay. Now, we're told that it was sold for how much? 11,200. Which means automatically there's a loss. If it's profit, it's positive. If it's loss, it should be what? Negative. In this case, there's a loss of how much? Of 800. Okay. Now, we're also told that the depreciation charge for the remaining plant and machinery is 24,000 and is included in operating expenses. Now, which means I don't need to work that one out like I was trying to do here before. That has been done for us. And what should I do? It has been computed for us. I'll just insert it. That's how much? 24. Now, let me reconcile the movement here. Therefore, I'll change this from depreciation to movement. Movement. Now let's look at what will have happened. If our opening balance was 242,000, we'd recognize the carrying amount of asset disposed of. I remember what was the carrying amount? 80,000. we take it out of it. Also, when you have depreciation, this is your kind amount, which means depreciation on plant. Also, remember 24,000. That 24,000 or 24 million, or figure in thousand. Take it out. Now, there was no evaluation because the whole of the evaluation was said to be for property, which means there was no evaluation in that. Therefore, what is our expected balance? My expected balance as at end of the year should have been this amount. And what is it? It will have been 198,000. But what do we have as our balance carry forward? From the balance sheet, we had balance carry forward. There is a movement between 198 and 220. Who can tell me what this stands for before I proceed? Okay, somebody raising up hand. Over to you, Toby.
I think that should be addition in the year.
That should be what?
That should be an addition in the year.
What does that mean? What does addition during the year mean?
It means that they have to be asset. They acquire another asset, kind of. They have to be
Which means during the year there has been acquisition or purchase of additional funds and what? Machine. Okay, where does that go to? That goes to investing what? Therefore, I can come here and see this. And is it an outflow or inflow? What? An outflow of cash. Okay. Next one. Disposal on plant. Disposal on plant gave us a loss. In this case, this is a loss. And what do? A loss on plant will have reduced our profits. Therefore, because it's a non-cash item, we are saying that it shouldn't have been. What do? We add back loss on disposal. Is that 8.8? Okay, what next? It seems in this case we've dealt all with this, therefore I'll take them out. Let me use green to signify that we've dealt with them. This has been dealt with. This has been dealt with. Now, let's quickly go to trade investments. Trade investments. In trade investments, what was the balance at the beginning? The balance at the beginning is 88. thousand, and the balance at the end is 120. We come here 8,000. The first question you ask yourself is, are there any additional information here that relates to trade investment? The answer is no. First, we've dealt with this, and I think we've dealt with this. But there's an element here that we have not dealt with. And what is the element? The proceed has not been accounted for the disposal. Therefore, we come here, proceeds on disposal of plants. And proceed is an inflow of cash. Therefore, we add that 11,200. Now, there's no information relating to, okay, there's information here relating to trade investments. Now, the investment income represents interest received on trade investment during the year. Okay? The trade investment suffered impairment loss of 10 million by year end. Okay, what then can we say about that? We come here to analyze it. If trade investment has suffered impairment loss, what does that mean? It means that impairment loss will have reduced the value of the trade investment. And it will have been charged to profit or loss. Therefore, this has reduced by 10 million, which means all things being equal, what we should have in our balance sheet should be 78 million. But what do we have in our balance sheet? We had 120 million. Now, if we bring that 120 million in, what does it mean? It means invariably that there have been addition to our trade investment to the tune of to the tune of 42,000. Therefore, acquisition of additional trade investment. Otherwise, the balance will have been 78. Okay. Therefore, we quickly go to investing activities and say acquisition of additional. Okay, so let me just link it together. And how much is that? Addition 2,000. All figures in thousands. Okay. Now, which means in this case, we have also dealt with trade investment to some degree. I'll take this out. Now, let's come to goodwill. Note 5. Goodwill. balance of goodwill at the beginning of the year was 38.5 million. We have no information about goodwill here, which means there was no acquisition of a subsidiary to increase our goodwill. Neither was there a disposal of subsidiary to reduce our goodwill. But there's something that reduces our goodwill other than those two, is that we will now compare our goodwill as at the end of the year with what we have at the beginning of the year. And end of the year, we are told it is zero. Now, for it to be zero, when we didn't dispose of the goodwill, the subsidiary, it then means that what has happened? What has happened? Who can answer that? Who can answer that? Send me a chat or you raise up your hand and let me give you access. What has happened to our goodwill since there was no disposal of a subsidiary that could bring about reduction in goodwill? What has happened in this case? The goodwill has been impaired. Yeah, people said impairment. That's nice. Which means there's an impairment loss on goodwill, which will have affected our profit loss. Which means there are two impairment losses now that we need to account for. One is impairment loss with respect to trade investments. The second one is impairment loss with respect to goodwill. Therefore, these two or those two will have reduced our profit. Therefore, since they are non-cash items, what do? We add them back. Impairment loss on trade investments and impairment loss on goodwill. I'll take them in one by one. I'm adding it back. That is that. Therefore, I've also dealt with this. What else do we need to deal with? Now let's quickly come to this number 5. The company paid an interim dividend of 25,000 and proposed a final dividend of 45,000. Remember, this is proposed. This proposed, let me put it in red. This proposed has no cash flow implication because it has not been paid. No cash, we have not paid cash at all. Therefore, the only one we recognize is the dividend paid to ordinary shareholders, 25, and that will come here as what? Dividend paid to ordinary shareholders. How much is that? 25 million. Now, we've dealt with this additional information. There's now one additional information we've not dealt with, which is the first one. Now, let me signify that we've dealt with this. We've dealt with this, dealt with it, dealt with this. Now, let's go to the first information. During the year, the company made a bonus of 1 share for every 6 shares held and a cash issue of 1 naira 90 kobo per share to provide funds for its anticipated expansion. Now let's pick it one by one. Let me put it here. note. What note is that? 6. Ordinary share capital. And let's pick it one by one. Now, step 1. I need to ask myself, what is the proceed? On issue of shares. Now, the first thing is that in 2020, the share capital was 72 million. Therefore, and we are told that the nominal price is £1.20. Therefore, let us analyze that. Number of shares. In issue in 2020. Recall, that will have been the share capital divided by the nominal price. Okay. Therefore, what is that? The share price is 72 million. The nominal price is £1.20 per share. Therefore, if you now use Excel to model it, what do we have? Which then means that my share capital nominal what? Price. I'll put it there, 72 million. And my nominal price is £1. Let me put both in there. Okay. Therefore, what do we have here? This divided by this. That's 60 million shares. Now, what do we do with the 60 million shares? Recall step 2. Step 1 is what is the number of ordinary shares in issue in 2020. That's step one. Step two is what is the number of bonus shares issued in 2021. And what do you do in that case? You ask yourself, what is the conversion ratio? Bonus issue ratio. We are told here that 1 share for every 6 years held, which means I'll say 1 new share for existing 6 years. That's 1 to 6. Therefore, the question then is the number of bonus shares now be equal to 1/6 multiplied by existing shares, which is 60 million. Existing shares. And therefore, what is that? That is 1/6 multiplied by 60 million. What do you have? Value by 6 million. Okay, what do you have? You have 10 million shares. And these 10 million shares, because it's bonus, step 3. What is the face value face value is same as nominal value of the bonus shares issued? Therefore, the nominal value is now the nominal price multiplied by the bonus shares. And what is that? Naira 20 kobo times 10 million shares. That gives you how much? That gives us 1 naira 20 kobo times 10 million shares will give us this amount. Now, which means our share capital had increased from 72 million by 12 million, which means has increased to 84 million. But we still have a problem. 84 million is not what is reported here. What is still reported here is 120 million. It then means that there are other cash issues relating to shares. Okay, and we need to trace that. Now we need to look at it. Step 3 or step 4. Let's look at cash increase in ordinary share capital. What is our balance brought forward? Our balance brought forward for share capital here is 72. Now, there was bonus issue. Add bonus what? Issue. Bonus issue is 12 million. Which means that should give me a total of how much? 84. This is what I expected. But what was my actual? Actual on the balance sheet is 120. Therefore, what is my addition? My additional cash, additional increase in ordinary shares. I'll call it cash back, which means this one was issued with cash, not bonus issue, not a mere capitalization of profits. Therefore, what's the difference? The difference is 84 minus 120. And that gave me 36. Therefore, I can come here and say cash effect or cash flow consequence of that is that I brought in 36 million in that year. But this 36 million, we can break it down as follows. If you remember, the nominal price is 1 kobo. Recall, the nominal price is 1 20 kobo per share. Therefore, we can use that to determine the number of additional ordinary shares issued for cash consideration. Therefore, now lead me to step 5. Step 5. Number of ordinary shares equivalent of that 36 million cash consideration. Now you ask yourself, the additional cash 36. The nominal price is 1 naira 20 kobo. Therefore, number of additional issue cash issue cash is what? Is 36 million naira divided by this. Therefore, this will be absolute number of shares. Therefore, remember, this is in thousands. Let me just put it in thousands. Let me put that 6 million in thousands. Million shares. Now, these 30 million shares, don't forget, there's an information here that says, and a cash issue of 1 naira 90 kobo per share to provide for fund for anticipation expansion. Therefore, what does that mean? What it simply means is that step 6, determine the premium on additional shares issued for cash consideration. And what is that? Number of ordinary shares issued for cash is 36 million. Oh, sorry, it's 30 million. Number of shares. Now, the market price, which is given to us here as cash issue, is 1 naira 90 kobo. The question then is, recall the nominal price is 1 naira 20 kobo. Therefore, what is the premium? Premium price per share is cash issue price minus nominal price. And what is that? That should be 1 naira 90 kobo, not 1 naira 20 kobo, and that is 70 kobo. Okay. Therefore, the question then is, the premium value equals premium price times number of new shares. And what is that? That is 70 kobo multiplied by 30 million shares. And what does that give us? 70 kobo and 30 million shares give us 21 million naira. Therefore, this 21 million naira, we found it somewhere before. And we're going to trace it. We'll trace it by saying movements in share premium account. What is the movement in share premium account? Figures are in thousands. Our balance brought forward. If you go back to this account, our bank brought forward is 0. It's 0. Now, here we add additional premium. Based on cash issue of ordinary shares. Therefore, this 21 is coming from where? Here. Which means we increase by 21. And this is what we expect to have. We expect to have 21. But what do we have? We equally have 21. Therefore, which means all is well. And there's no other difference. Therefore, the difference between these two is 0. No difference. No other differences unaccounted for. That's nice. Okay. And that's it. Which means that here we have cash consideration for ordinary share. We also have premium. The premium aspects. That's 21 million. And that is that. Now we've dealt with all additional information. Sorry. Which means we are close to home. Now, when you finish dealing with all additional information, what then do you need to do? You come to the balance sheet and see whether you have dealt with all of the balance sheets. Now, we've not dealt with current asset section, and we know why. Because now we can now move on to what I'll call changes in working capital, or movement in working capital. Now, I want to look at it. What are the movements in our working capital? If your inventory increase from what it was last year to what it is this year, are you spending more money, or net are you gaining more cash? You have to look at it logically. If the value of goods I had before is 10 million, now they are 12 million within the space of 1 year, which means net I'm spending more cash to increase my inventory. But if it was 10 and it's now 8 million, I've more or less recovered more cash by way of selling to deplete my inventory level, which then means that an increase in the working capital changes between 1 year and the other will bring about utilization of cash. While decrease in that in that current asset, such as inventory, will bring about increase in cash. Therefore, what do I do in this case? I come here and say, for this inventory, there has been increase in it. Therefore, I'll deduct increase in inventory. And the inventory has increased from 265 to 325,700. 325,700 and that's 265. Therefore, 325,700 minus 265,000. Therefore, net, I have 6,700 as increase in my cash, and I say I should deduct. Therefore, I deduct that. Also, my trade receivable has increased from 190 to 203.50. Increase in trade receivable is now 203.50 from 190, and that will give me 203.50 minus 190. So I should deduct it. Net is 13,050. Now, when it comes to cash and cash equivalent, you don't do anything. Take note. Why? Because that is what we are working towards. This is what we are working towards. Therefore, I come down. I have my trade payable. It has decreased from 350,200 to 260,500. Okay. I'll also deduct decrease because I pay more money to my creditors. Decrease in trade payables from 350,200 to 260,500. $350,200 to 260. That is that. Okay, there's no other item there. Bank overdraft will be treated as cash equivalent for cash flow purposes, while taxation will be treated separately to determine the tax rate. We'll get to that level. Now, at this point, what do we have? Now, let's come back here. All of these items here relates to non-cash item, while some of these other items relates to non-operating item. And what are they? The first one is interest received on investment. Remember, we are told here that the investment income represents interest received from investment, and that should go to investing activity, which means this investment income here, 18,000, was said to be actually received in cash, and we need to treat it as an investing activity, but it's already embedded in this profit. Therefore, what do? I deduct it from here. I classify it to investing activity. Therefore, deduct interest received from trade investments. $18, and I'll classify it here as interest received from trade investments. And the cash inflow, therefore, it has come here. Another one is interest paid on borrowing. Interest paid on borrowing. We'll come to that. Now, let's come to this level. There's a finance cost here, 26 million. Okay, and it doesn't constitute any payable because there's no other payable other than trade, which means that amount has since been paid. Okay, and that amount relates to, let's break it down. I call this note 6, let me call this note 7. Let me bring note 6 down here. Note 6. Finance cost. The first thing is this. The finance cost is considered to have been paid because there was no accrual or other payables in the balance sheet. Therefore, that is so clear to us, which means such has been paid, because if it has not been paid, it will have been in our balance sheets. That's the first thing we need to take note. Second is that the finance cost can be broken down into two components. That is, the component of preference dividend paid to preference shareholders Remember, there's preference shareholders here. Redeemable preference shares. Remember, from IS 32, that will have been classified as a liability. Financial liability and other borrowings, which may have been paid down in the year. Therefore, invariably, the components as thus. preference dividend. What's our preference dividend? Come back here. 8.5 redeemable preference shares. And we have assumed here that this preference shares was obtained on 1st of January, 1st of April, no, March 2020. And it stays until today, which is 30th of April 2021. Therefore, what it simply means is that we are going to compute full year interest. That is 12 over 12 months multiplied by 8.5, 8.5% multiplied by 32 million. And that is that. Okay. Others relates to the balance. Remember, everything was 26,000. And if we are broken down 26,000, what do we have? We now have the balance. Others. Other finance costs. 8. Other borrowings. So that's it down. We have 26 million. Our finance costs, which we have here. You can see it here. Now, the difference between 26 and 2,720 will give us this. This is a balancing figure. I'll put it in red. Now, let me give you some assumptions I've made so that it can assist you. Even though if you decide not to separate it, it's still okay. There's no problem with it, since you are still going to treat it in the same manner. The first is that it is assumed that the preference shares were issued at the beginning of the year. The dividend has since been paid. Since it is redeemable preference share which qualify to be classified as financial liability in line with IAS 32, then it has been presented in the financial statement as a component of finance cost. And as you arrive at the amount is 8% of that 32 for the whole year. Other finance cost is the difference. For the purpose of statement of cash flow, finance cost as considered paid is to be presented within financing activity. But again, as I've told you, it's a choice of a company based on its accounting policy and depending on the industry it belongs. It may treat it as an operating activity. It may treat it as a financing activity. But for this case, I'm treating it as a financing activity. But I discovered that I can always prefer to treat it as operating. But again, it depends on the perspective you are in. Therefore, I'm going to classify it out of here also. Remember, preference dividend on redeemable preference shares. also deduct interest paid to interest paid on other borrowings. Okay. Now, all things being equal, what do we have here? We have 87,300. Am I right? Sorry, I think I missed it. I can't deduct this. I'm to add the dividend paid and the interest. Sorry. Add because it has been deducted before. Therefore, what do you do? Reverse is the case. You add. Okay. That's 139,300. Therefore, once I add that to that, I have my cash flow from operating cash flows from operations for in capital changes. Now, working capital changes. What's the total effect of that? That's this. Next, once I sum it together, I have my cash flow from operations. After working capital changes. And the last information is tax paid. Now, which will be my 8. Tax paid. During the year. What's my tax paid during the year? I start with my balance brought forward. Balance brought forward for tax was 107,400. 107,400. Now, what was the charge for the year? Remember, tax for the year is current tax aspect, not deferred tax. If there's deferred tax, you remove it. But in this question, it's so simple that there's no deferred tax. Otherwise, you'll have removed the element of deferred tax if included in the income tax. Now, the entire 28,340 is our current tax, since there's no deferred tax element in it. You might refer to my video on income tax, IS 12, for clarification with respect to that. Therefore, I come here, that is 28,340. Therefore, if I've not paid anything in that year, This is what is supposed to be. This is the expected balance carry forward. Assuming no tax paid. But what is the balance I have? The balance I have was showing 65,200. It means I've paid down. It means I've paid down. I have 65,200. Therefore, the actual tax paid in the year amount to what? $135,740 minus 65,200. That should give me 540. I come here. I say tax paid. $75.40. All things being equal, I have deficit in my cash flow position, and therefore I'll consider that as net cash outflow from operating activities. That's 9350. Therefore, I can shift this one upward. That's the beauty of Excel, but you can do that. Okay. Also here, I think I've dealt with all investing activities. And what is the net position there? It's also net cash outflow. I'll just come here, net cash outflow. Now from investing activities. Now remember, these two that I said I should treat under financing activity, I'll bring them down. There are even three. Okay, I've dealt with the trade investment. I'll bring them down here. That is the case. I'll deduct them here. Okay. There's something also I've not dealt with. The preference dividend, the redeemable preference shares have also received cash when we borrowed. Remember, cash proceeds from issue of preference shares. Remember, we received 32 million. Coming from 0 to 32. Therefore, that is 32 and 0. That's 38. Therefore, this is positive. Therefore, I'll call it cash inflow, net cash inflow. From financing activities. And the net position there, when we consider the three, these three, let me put them in a separate column. What color should I put them? Okay, wait, this is negative. I'll put it in red. This is negative. I'll put it in red. This is positive. I'll put it in green. And what's the net impact on cash? Negative, negative, and positive. The net position is negative. Net decrease in cash. Which is, I'll put it in red. And what I now need is cash and cash equivalents. As at end of last year, first year ends April, therefore it means it will have started May 2020, and cash equivalents as at 30th of April. Therefore, we put this two in black. Okay, now here you come up and drop your cash and cash equivalents, represented by cash and cash equivalents. Now I have 2 years, 2020 and 2021. Or figure in thousands of naira. Now, what are the composition of it? We have cash and bank, and we have bank overdraft. And what's cash and bank in 2020? Is 10,200 and 64,000. What is overdraft? 3,100 and 90,05. 3,100 and 90,050. Okay, therefore, what do I have? 19,990 050. Now I need this 19,990 at my opening in 2020. And I come here, I bring it down. Therefore, my net position and net overdraft is which tally to what we have here. Let me put green to show that we are home and dry. And that is that. Which means we are able to show our net position. We are in net position of overdraft. And that is our position in this case. Therefore, I'll call it, this is my solution. But I can replicate this solution where what if I can say this one is a solution. This, what do I want to do? What if, according to Ican, they still treated this, even though they removed it from adjustment, but they treated it within operating activities rather than what? Financing. You are still going to get the same thing, which means I take it off this and I treat it within, let me push this down. I treated it within these activities. Oops. And also, they decide not to split it, like I've done this splitting for your understanding and against the future. They decide not to split it. Then my objective is for you to have better understanding so that you can be able to address as many issues as possible in the future. Therefore, in this case, what do you have? Have this position. And you have increased position here. Your result will still remain the same. Again, the beauty of it is that IS7 and IS1 requires you that you must constantly apply whatever you have chosen so that it's not year in, year out. You are swinging it. Okay. But that is a position here. Any other question? Any question? Any question on this? I can't see any hands up. That means we are well abreast of this, if that is the case. Now, what was the next question? Now, the next question they ask, okay, wow, thank you for, okay, no problem. Now, the next question is, let me switch. The next question was, Okay, they said in the context of IS 7, statement of cash flow, explain the term cash and cash equivalent and list 3 examples. Okay, see what I've tried to do for you guys, which I know that many students were able to answer that. And I want somebody to volunteer to read this. Can somebody volunteer? Okay.
Cash comprises cash on hand and demand deposits. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and subject to an insignificant risk of changes in value. Cash equivalents are held to meet short-term cash commitments rather than investments or other purposes. For an investment to qualify as a cash equivalent, it must be readily convertible to a known amount of cash and be subject to an insignificant risk of changes in value. Therefore, an investment typically qualifies as a cash equivalent only when it has a short maturity of, say, 3 months or less from the date of acquisition. Equity investments are excluded from cash equivalents unless they are in substance. Cash equivalents, such as preferred shares acquired within a short period of their maturity and with a specified redemption date. Examples of cash and cash equivalents: 1, demand deposits; 2, tenor or fixed deposits; short-term marketable treasury securities, such as treasury bills of 3 months or less, and bank overdrafts.
Thank you very much. Thank you very much. Thank you very much. Okay, that is that. If there are any other questions, you are free to ask, whether on statement of cash flow or on every other general problems. Questions? You can send a chat or you can show by raise of hand. Okay, Toby.
Yes, sir. I think I posted you on the group so that I should answer question 1, 2017 or so, May 2017.
Okay, time will not permit now. But if you have specifics of those questions to ask, okay, I can do that. That is not trying to solve it from beginning to the end, because the time we have left cannot permit us to do that. But if there are specific principles there you want me to demystify, I will do that.
All right, thank you.
Okay, we have some time to answer specific questions, clarification, and other things. Any other questions, specific questions, whether in statement of cash flow, in any other topic relating to financial reporting? It seems you guys are home and dry. Okay, which means this will likely be the last revision class for November 2022 Ican skills level financial reporting examination. Okay, in the light of that, I think I wish you guys well, and I believe success is yours. And one thing again is this: one thing is to prepare to pass exam, and the most important thing is to prepare to be able to meet up with the real life world challenges to solving problems for businesses and being business partners. Okay, in the light of this all, I wish you success in your forthcoming exams, and we'll surely see at the next and higher level. Bye, and God bless you. Oh, thank you.